opportunity to talk a little bit about some of my thoughts on how this phenomenon, this cryptocurrency phenomenon might intermesh with, say, the Fed, for example. So I'm talking today about this concept of FEDCOIN, and it's on the desirability of a government cryptocurrency. So let me just give you a summary of what I'm going to be talking about here. You know, I like to think about the payment system as a protocol for debiting and crediting accounts, right? And I like to think of money as the object that is used to debit and credit accounts within that payment system. I think that these two notions are conceptually distinct, and I think it's important to understand that because the premise of this talk is that Bitcoin and other similar cryptocurrencies, while they may constitute a good payment system along certain dimensions, my claim is that I don't think that they consist of very good monetary objects. And I'll spend some time defending that claim for you. But to the extent that that's true, this opens up the door for some innovation. And an innovation that potentially the government or some government agency can step in and do more efficiently than the private sector. And I'll defend that statement as well. And the notion is FEDCOIN, which is a term not original with me. It's something that I actually came across on the blogosphere. Jake Coney, I think, was the first to coin the term. But basically what this is the idea of combining the Bitcoin payment system, or the protocol, with the US dollar as the monetary object. All right, so when I lecture to my students on money and payment system, to give them a kind of a broad overview of what I'm talking about, I use a picture like this. I mean, this is really what we're talking about here. I mean, we're talking about, if you want to think about those little marbles in those compartments as constituting monetary objects, they could be US dollars, they could be euros, they could be gold coins or copper tokens. They could exist physically, they could exist virtually. These different compartments you think of as different the wallets. All of you have different wallets or different accounts. They may exist personally on a person. They might exist on some ledger, in some centralized ledger. The ledger might be private, might be proprietary to the bank. And it might be a public ledger, like Bitcoin, for example. You can basically see how many marbles everybody has, how many marbles every wallet has. And the issue about the payment. But with the emergence of strangers, I mean, how do you facilitate credit exchange with strangers? And so one interpretation of the emergence of physical money is exactly this issue that physical tokens were an innovation that permitted anonymous peer-to-peer exchange. Okay? So, the Roman soldier coming through the village, I mean, you're not going to extend him credit, you're not going to give him a beer, with him promising to pay you back later, because he's probably off to the frontier, but you would accept some sort of token. That was kind of a substitute for this missing virtual memory. So, of course, this requires a trusted third party to manage the money supply. And also, we had this emergence of this virtual book entry money, right, used in tri-party exchange. And here I'm thinking of, the Medici bankers, for example. So this provided a safer, more efficient way to facilitate payments, especially large value transactions, right? But again, this is typically operated with a private ledger, and it has to be maintained by a trusted third party. So all of these payment systems, basically they coexist. They've coexisted through much of our history. They continue to coexist today. So when we're thinking about, the question of an optimal payment system isn't necessarily like finding the optimal payment system. It's very likely that the optimal payment system is going to consist of a variety of mechanisms that are going to coexist. If we take a look at money and payments today, in most jurisdictions, money consists of central and charter bank liabilities, the supply of which is determined by various protocols. And the money supply itself largely consists of, it comes in two forms, right? It's paper, we're familiar with the paper, and the coinage is relatively trivial, but paper form, physical form, and also virtual form. An important question, who is in control? Well, the proximate control is delegated to representatives of the banking system. We trust the policymakers at the central bank to govern various aspects of the monetary policy and payment system, the chartered banks, the money services businesses. But, the ultimate control is in the hands of the citizens and other users. So, so the Federal Reserve, for example, was founded by an act of Congress just over 100 years ago. Congress being elected representatives of the American people. And the protocol and the mandates laid out in the Federal Reserve Act, right, evolve over time as we receive feedback from the community. So these things aren't set in stone. So in some sense, I've likened the Federal Reserve to some, I likened it to the Bitcoin open source protocol in that, some aspects of the Federal Reserve operating procedure, the mandate, the Federal Reserve Act is open source. You can go and read it. You can see how Congress has prescribed the way we have to behave in many respects. And just like the Bitcoin protocol, we take feedback from the community, and the institution evolves over time. It's not fixed in stone. An important part to emphasize here, I think, is that the supply of paper money is not determined by the Fed. Okay? So if you take a look at the Fed's balance sheet today, right, a large fraction of our liabilities are in the form of just reserve deposits with chartered banks, and these exist in electronic form. The supply of paper is demand determined. It's determined when I go to the bank and I want to make a withdrawal or redeem my bank liability for cash. That's how cash gets into the system. It's not a decision that the Fed makes, it's a decision that we make. So we can choose to, so the Fed doesn't control the composition of its liabilities. And the reason why I mention this is because the same principle is going to hold for this FEDCOIN concept. The Fed's not going to be able to control the supply of FEDCOIN in the way I'm going to describe this. But it shouldn't be such a big deal because the Fed doesn't control the amount of paper cash either. That's the argument I'm going to make. Okay, let me talk a little bit about the properties of paper money. Well, one property is that it's relatively difficult to counterfeit. It's not impossible. But essentially, a well-designed paper or a well-coined object, for example, is difficult to counterfeit. And this basically solves the so-called double spin problem. Paper, tokens, physical money facilitates local peer-to-peer exchanges. There's no middlemen required. I emphasize local here because obviously there's limitations to what sort of transactions you can take place in a peer-to-peer manner using physical paper, physical tokens, without the use of an intermediary to carry the money over long distances, a post office service. But the key is you don't need a bank, right? You just settle, the accounting is done. You move those little marbles in that box, it's just between you and the merchant. It's a permissionless system. I don't have to get permission to hold euros in my pocket. I'm allowed to hold US dollars or whatever I want. It's costless to open a wallet. The wallet is just my pocket. So there's no formal procedure to open up an account. There's no application process. There's no personal information is relinquished. There's no ID is necessary to present. Which is arguably a benefit, in particular for poor people who sometimes have difficulty identifying themselves. So cash is kind of a preferred payment mechanism for poor people. But even for people who can identify themselves, right, you don't have to worry about the issue of identity theft. It's kind of like the push from wallet versus pull from account property of cash is attractive as well, because there's less fraud associated with push systems, right? I don't have to worry about funds being pulled out of my account because somebody's compromised the account of the bank or somebody's stolen my identification. And likewise for merchants, right? Merchants don't have to worry about chargebacks. There are downsides though. I mean, it's kind of costly to store large balances. You don't necessarily want to be walking around South Philadelphia with thousands of dollars in your pockets. Merchants have to empty out their cash registers and hire security, armed guards to kind of deliver their physical cash balances to the bank. So there's some costs. But one important property is that there's no KYC requirement, know your customer requirement. And for better or for worse, what this means is it permits anonymous exchange. Okay? And it seems that authorities, at least in the United States, are somewhat ambivalent on this property of cash. I mean, there's a significant fraction of, especially the American population, that values the personal privacy very highly. The government has no business in if I want to go and gamble, for example, or whatever, do whatever, why should I be prohibited from doing so? And also, I guess it would be just infeasible to impose this on every cash transaction. I mean, can you imagine, before you accept change at the vendor, the kebab vendor, I mean, do you have to ask did this money come from some illicit drug trade? I mean, a large fraction of economic activity would likely grind to a halt if the government actually tried to impose KYC requirements on every cash exchange. So there's arguably some benefits to not having KYC. And finally, for the United States at least, the paper money is a source of significant external senior journalism. For some reason, people around the world like to hold U.S. $100 bills. And I guess the United States is more than happy to print them up. So, we print up 100 large bills and we ship them over to Russia. And the Russians ship us back vodka. So, in exchange of liquid assets. It's a nice trade. Okay, so what's with peer-to-peer digital money? Well, what's the issue? What's the difficulty? The difficulty is the double spend problem, right? If I spend a paper note, I take it out of my pocket. I mean, there's no question it's out of my pocket and it goes into the cash register. Assuming I can't counterfeit the note, I mean, there's no question. And so the electronic equivalent would be, if I'm trying to send a digital file consisting of a monetary object, say I want to email it to you, the electronic equivalent would be that once I email you this file, I would delete it from my account. I don't think we can trust people to do this. I mean, this is like, people are going to be tempted to retain copies of these digital files and kind of spend them over and over again. In other words, it's costless to counterfeit digital files. And that's what's made digital money so difficult. I mean, you can think about ways around it that, basically, it's very... In 2009, the Satoshi Nakamoto white paper actually proposed a solution to this double spend problem. So, Bitcoin. I presume most people are familiar with Bitcoin at a conference like this, so I'm not going to get into describing the details, right? It's an open source protocol designed to process peer-to-peer payments in a native digital currency without the use of a centralized and trusted intermediary. So we're all familiar probably with the blockchain, the concept of the blockchain, the notion that instead of the banks, what you have are these kind of volunteers from the community called miners, which are really, in fact, payments processors, and that these payment processors are, through some clever algorithm, kind of the details of which I'm not going to get into, are at the end of the day, you have to pay these guys for processing the books, just like you process banks. The only difference here is that, in principle, anyone can become a miner. It's kind of democratic in that way. Of course, in practice, it turns out to be a little bit different. But these main miners are paid in Bitcoin. And how the miners are compensated, it actually is in two forms. First, seniorage, that the protocol actually uses seniorage to finance the miners' costs. And so in that sense, it's not very much different than the way seniorage refers to the printing of money to finance operating expenditures. So governments are well known to oftentimes resort to the printing press to facilitate or financing expenditures. The Bitcoin protocol actually builds this right in. Although, of course, the protocol also, the seniorage revenue is going to at some point go to zero, because according to the protocol as it exists in its current incarnation, the supply of Bitcoin is going to be capped. And the other source of financing the miners' expenses through user fees, which are presently are relatively small, but are, who knows where they're going to go in the future. What are some properties of Bitcoin? Well, anyone can open a wallet, right? A wallet software, you can just go and download it. You don't need permission. It doesn't cost anything. So in this sense, it's permissionless. And it has the same property as cash in this regard. The wallets are not necessarily identifiable, right? You can download as many wallets as you want, basically. And nobody needs to know that it's your wallet. And you can be like just transferring funds across your wallet. So in this respect, it's kind of similar to cash. But it does have a property that's very different than cash, right? For cash doesn't leave a paper trail. But Bitcoin by construction does. Right? It's actually recorded on the blockchain. That every Bitcoin, you can actually, at least in principle, track where it's been, which wallet it's tracked to throughout its history, its entire history. You may not necessarily know the identity of the wallet, although there are ways. There are ways to kind of figure it out. But this is a property that is unlike cash. Transacting in the native currency seems to cost almost nothing. I've tried it. I did it myself, actually. When I actually went and I downloaded a Bitcoin wallet, because I said, what am I doing lecturing on this if I don't know actually how it works? And so the first problem I ran into, of course, was I didn't have any Bitcoin. So I went to my Twitter account and I tweeted, is there anybody out there who would mind sending me a few Bitcoins? I'll send them back to you. I immediately got this flood of tweets, Senior Fed official engaged in biggest scam ever. But somebody from the Cayman Islands sent me about $10. And then I sent it back. Yeah. And it cost me nothing, although I have to say, it did take a few days to process because I didn't want to pay the miners any fees. So the miners kind of ignored me for a while, but it didn't cost me anything. So the user fees are low, at least presently. Actually, this is an open issue of research as to where these user fees are going to go in the future. Some people are saying that they're going to remain low. Some people say that the user fees are going to have to rise once the seniorage revenue falls. That's an area of active research. The fact that the user fees are so low kind of, I think, masks the true cost of operating the system. Because if you take a look at the compensation to the miners as, say, a ratio of the total volume transacted, and this is all public information. You can go to www.blockchain.com and download this information. Miner compensation is currently around 2.5% of transaction volume. So it's not really high, but it's not zero either. And the way this is being financed is through seniorage. And again, so there's an inflation tax that's masking the true cost here. So users think that somebody has to bear the cost of the expense, right? Of the hundreds of millions of dollars that are being used in electricity consumption and in hardware. And this is where it's coming from. In addition, the user costs rise when various intermediaries are employed, right? And suppose I go to an ATM, a Bitcoin ATM machine, I have to pay the ATM a little cut. I use the Bitcoin, I use it in a transaction. At the other end, if they want to convert it back into euros or US dollars, again, they have to a little transaction cost. Sometimes it's kind of ironic, but there's these services that if you want to put your Bitcoin in cold storage, like Zappo will provide you that service for a fee. But the point is that there's all these intermediaries arising to offer various services to make make it easier to use and store Bitcoin, which is a little bit ironic, I have to say, in light of the whole philosophy of the program is to bypass the need for intermediaries. And yet we see even in this space, there seems to be a huge demand for intermediary services. Another property is I can send money to anyone in the world, right? The peer-to-peer now is not just face-to-face. It's like to anybody around the planet who has an internet connection. And it's kind of fast in that regard. It takes 10 minutes. It's not instantaneous. It's actually a parameter in the protocol that actually can be changed. You know, if you take a look at the ACH system in the United States, the automatic clearinghouse and the correspondent banking structure today, it's very slow. Although I guess it's fast relative to like 50 years ago, it's slow relative to what you think it could be. I was just at a conference in Washington, D.C. The Treasury Department just hosted a conference. They're very interested in various aspects of Bitcoin. And somebody there said, it's presently faster to fly to Europe than to send money. And then, you know, you're walking around the hallways and, you know, you hear people talk about Western Union. I can't even repeat what I hear. Just like that. So people are not very happy with various, you know, the charges that some of these money services businesses charge, especially for international remittances, right? The protocol is open source, so it's kind of transparent in that sense, although, you know, according to one source, I mean, the source code is about 17 megabytes in size, so if you want to think about the size of 500 phone books, it's like, I don't know if the kids these days know what a phone book looks like. In the old days, we used to have these books, phone numbers. They were big. The code is written in a language that, you know, most people don't understand. There's like some people in the community do. If you take a look at the blockchain, it's open source. Go take a look at it. I ask you, go download it right now. Go take a look at it. It's 30 gigabytes in size almost, and it's growing very rapidly. So, you know, to the average person, I mean, this is meaningless, which is fine. But it is there, right? I mean, if you want, you can go see it. And another important property of the protocol is that the money supply is essentially fixed. I mean, it follows some sort of deterministic path, but it's deterministic and it's going to basically cap out at 21 million units. Okay, so now on to the kind of the substance of my talk. I want to first of all say why Bitcoin is not good money. It might be a good payment system. Actually, I've been on record as describing the innovation as the work of genius. I mean, I really believe that. The blockchain is just this amazing thing, and it's going to have huge implications, I think, not only in finance, but elsewhere. But monetary object is not a good object. Why is that? Well, there's a couple of reasons. The first reason is, you know, like it or not, the US dollar is the numeraire in the United States. Yeah, of course, feel free to replace US dollar with euro in Europe. But you know, the numeraire, that means that the prices of goods and services and contractual terms are stated in US dollars. And these contractual terms, for better or worse, are highly non-contingent. And I don't see this situation changing anytime soon. There's just a huge network first mover advantage. You know, that the dollar is the numeraire. All right. Well, what this implies is that managing cash flow becomes a bit problematic, doesn't it? If for example, your revenue is in Bitcoin and your obligations are in US dollars. Of course, the same sort of problem emerges if your revenue is in euros and your obligations are in US dollars, or vice versa. This is the big problem with foreign exchange, and why there's why the institutions of fixed exchange rate regimes or common currency areas continually re-emerge in history, is to deal with this problem. So managing cash flow becomes problematic if the exchange rate is volatile. And as we know, the Bitcoin exchange rate is volatile. And even if you expect the volatility to diminish, there's you know, no guarantee that it's going to be gone or that it just won't suddenly appear in some sort of crisis situation. That's been our history with exchange rates all the time. So, you know, there's certain things that could happen. Intermediaries can mitigate this risk, but there's added expense, you know, to hedging against the exchange rate risk. And again, if you do so, you actually have to trust the third party to actually deliver on their obligations in states of the world that go against them. The second reason is that even if Bitcoin becomes the new murder good, this is kind of the vision of the true believers. Imagine Bitcoin becoming the currency out there. Even if it were to go to that stage, which I don't believe it will anytime soon, I would argue that it's still a lousy monetary instrument. I think the protocol, at least the way it's currently designed, is a lousy monetary policy. It basically says keep the money supply fixed. And that's almost surely suboptimal. And you know, we have a lot of experience with kind of regimes with kind of relatively inelastic money supplies, kind of like gold standard regimes. You know, there's some good. There's a good side to these regimes, and there's kind of a bad side. The bad side is that because money demand can be volatile, especially say in a financial crisis, the demand for money might rise dramatically because money, this type of object is frequently a safety vehicle, so people flock to the safety vehicle. What this does is if the supply of money is fixed, it's a huge deflationary event, right? The purchasing power of this object just rises dramatically. And again, if your obligations are stated in nominal terms, you know, you imagine firms seeing the price of the goods that they sell plummet in a crisis, but their wage bill is still denominated in nominal terms. This might mean layoffs and contraction. It might, you know, so this is just a well-understood argument in macroeconomics. I'm not going to repeat it here. So there's a couple of reasons why Bitcoin is not a good money. I want to make one comment on trust. You know, the claim that Bitcoin somehow functions without the need of trusted intermediaries is, I think, sometimes taken too far by enthusiasts. I want to make this claim because, you know, I'm not going to be advocating FEDCOIN, kind of this idea, well, you can't trust the government. Well, you know, what makes you think you can trust these guys? I mean, again, the issue is you know, if you think about it, for the average user is never going to be able to read C++, let alone 30 megabytes of code, and the blockchain is, you know, I mean, it's meaningless for the average user. So in this sense, core developers are in some sense a lot like Fed monetary policy officials. You kind of trust them, that they know what they're doing, and that they can fix bugs and recommend patches. And these miners actually, while in principle the original vision was to have a decentralized set of miners, that in practice what's happened is that they've coalesced, right? You see these big mining coalitions. And you wonder whether or not these mining coalitions, whether their interests are aligned with the broader Bitcoin community. It's not entirely clear that they are. So at the end of the day, you know, for the typical user, you're going to have to come to trust the money and payment system the way we trust, you know, the way we trust cars to function. I mean, we don't necessarily know how the internal combustion engine works in every detail, but we drive because we have history of you driving cars and we see the experience of others. So I think reputation based on experience and trust is key, even in this space that we're talking about. So the issue is not a lack of trust. The issue is how much trust do you need and where is the trust best located. Okay, so now let me describe my proposals. The first one is FedWire, which I have the acronym there, FALL, which I don't like so much because it almost looks like Fed. FedWire, as you might know, is a real-time gross settlement fund transfer system operated by the Fed for almost 10,000 financial institutions. Well, you know what? I know this sounds radical, but why not permit personal checking accounts at the Fed? Why limit it just to banks? You know, maybe there was a good reason not to do this pre-internet days, but, you know, come on, the internet's been around for a while now, and these online accounts are now possible. Now, I realize I'm glossing over a lot of details here, you know, and stuff like that, but, you know, come on, it is possible. And in fact, the U.S. actually does have something similar to this right now. I just learned about this the other day. The U.S. Treasury operates something like this. It's called Treasury Direct. just go to www.treasurydirect. And what this does is that it permits U.S. citizens to open online accounts with the U.S. Treasury. You can buy bonds at auction with these accounts. And moreover, it's costless to open the account, and it's costless to send U.S. Treasuries across accounts. And in fact, fractional amounts of Treasuries are permitted to be transacted as well, at least within the system. If you want to go outside the system, you have to use an intermediary. Who's playing that music? Is that you? It's nice. I like it. Okay, so, this FedWire, I think, has some advantages. I mean, among other things, you think about FDIC, the Federal Deposit Insurance Corporation, the insuring deposits. Why do we need it? I mean, if you take a look at the structure as it exists today, you get the feeling that it looks like this rickety scaffolding that's built on a distributed pre-electronic system. Right? Fair enough. I mean, people are doing the best they can, given the technology at the time. But the technology is advancing. What FedWire for All would do is provide a counterparty risk-free place to store value for everyone, firms and businesses. There'd be no need for FDIC. I mean, what would it mean to insure an account at the Fed? The Fed could just print the money. It's just going to be there. Right? And in any case, FDIC limits are trivially small for businesses. If I've got $500 million that I want to park overnight, and I'm managing cash flow at a business, I'm not going to put it in a bank necessarily because the FDIC covers $250,000 worth, right? I might actually go to the shadow banking sector. I might go to the repo, in fact, where I can at least get some good collateral for the deposit. In terms of payments, this is potentially much, much, much cheaper, right? Just imagine if we all had Fed accounts or accounts with the ECB, right? We just debit my account, credit your account just directly. It could be very, very low cost. You might argue that governments are not very good at customer service. That's probably true. But you know what? You could permit banks to open these accounts on behalf of customers. The Fed may not be good for you. You don't want somebody walking up to the St. Louis and Fed go, I lost my password. Or something like that. Well, let Bank of America or Chase Bank open an account for you and manage, service the account. They'll charge you 25 or 50 basis points for that. That's fine. But it's not quite cash, right? It's not permissionless. You still have to go through the application process. There's the KYC restrictions. And so it opens the door for other cryptocurrencies, which may be a good thing. We might want to just leave it there, right? The Fed operates FedWire and then says, Bitcoin, Litecoin, all you guys, you go and fill up the niche markets that remain. But I'm proposing that the Fed could even go further, but it would have to overcome this KYC hurdle. And so here's my pitch. The government doesn't insist on KYC in all cash transactions today, right? Maybe because it's infeasible, maybe because there's constituents that would rise up in arms and overthrow the government if they did. But whatever. The governments today do live with the fact that cash, we don't insist on KYC for cash transactions. And so, why insist on it for digital cash transactions? The world's not going to come to an end. The world has somehow societies have survived cash, the lack of KYC. This is not, So I think the government needs to kind of let go here. Just let digital cash function the way paper cash does, and let law enforcement do its job separately without breaking the payment system. And in any case, unlike physical cash, digital cash is going to be much easier for law enforcement to track, right? It's not immediately clear that criminals will want to use Bitcoin, because the ledger does keep track of where these objects travel from wallet to wallet. And the same would be true for the FEDCOIN object. So, the second proposal, FEDCOIN, how would this work? Well, kind of easy, right? We got the basics, it's out there, in the public domain. The Fed could release a Bitcoin clone, suitably modified. And the key part is that the protocol would maintain a fixed exchange rate between FEDCOIN and the US dollar. And you might ask, well, how could you do that? it would be no more difficult than the way the Fed currently maintains its fixed exchange rate system, say between Abraham Lincoln and Alexander Hamilton. Okay? Do you think about it, you ask, why does it take 2 Lincolns to buy a Hamilton? That's not a market-determined rate. The Fed does it. I mean, if you try to sell your Hamilton for only 1 Lincoln, the guy's going to forget it. I'll go to the Fed. The Fed will give me 2 Lincolns for my Hamilton. Why should I? So it's the credible threat of maintaining this fixed exchange regime that makes this idea very, very attractive. Right? We believe that the Fed can maintain this fixed exchange rate system because the Fed prints both types of currencies. And that's going to be true of FEDCOIN and, say, paper US dollars. And there's no private sector entity that can provide the same sort of guarantee, right? And that's because no private sector entity would have the ability to print US dollars. And that's why I think the comparative advantage in this scheme lies with the Fed, the government. You have to worry about minor compensation. That's fine. I mean, in fact, there's the Fed could potentially pay interest on money on this FEDCOIN, and it could potentially compensate the miners to the extent that it draws the hashing power away from other communities towards the Fed, making the Fed blockchain much more resilient and attractive for users. The Fed should probably not become a miner because I think maybe the Fed could not credibly claim that every transaction will be processed blindly the way it is with cash, but that's a detail. What are some monetary policy implications? As I mentioned, the Fed would have no control over FEDCOIN in circulation, but I already mentioned that's also already true about cash, so what's the problem? I think it would make monetary policy, in fact, a lot easier. If you take a look at what's going on in terms of monetary policy in the United States, at least, and you think of what they're trying to do with the interest rates and which interest rate to use, traditionally they use the federal funds rate, which is an interbank interest rate. The federal funds market is basically non-existent since the crisis. And since the crisis, the Fed has used the interest on excess reserves, the IOER rate, which is currently set at about 25 basis points. And now the Fed is experimenting with the so-called overnight reverse repo facility, which is basically a way to pay interest on deposits for a limited amount of counterparties. But why? Currently the IOER rate is going to be here, and the ONRRP rate is going to be there, and there's discussions about whether or not increasing the interest on excess reserves is going to cause the federal funds rate to rise. I mean, it just drives me crazy. I shouldn't say that. There's precedent. I did not say that. It's interesting to debate the issues. But why bother? I mean, with broad access to Fed accounts, the policy rate could just be the interest rate on FEDCOIN or FEDCOIN. If you want to raise the interest rate, just raise the interest rate on FEDCOIN. If you want to lower the interest rate on FEDCOIN. And with broad access to Fed accounts, repo as a cash management tool for firms might no longer be needed. So let me conclude here. The Fed already has a permissionless monetary instrument, cash, with many economic benefits and some costs. Why not extend paper cash to the digital realm? True, the U.S. paper has a low negative real rate of return. That's just another way of saying that the inflation rate is low. Is about 2%, but it's stable. Since for about 30, 35 years, the Fed has maintained a pretty low and stable inflation rate regime. And as I've argued elsewhere, I argue that the stability of that rate of return is what's important for a good property of a monetary instrument. The short-run stability of that return, not necessarily the long-run rate of return. But with FEDCOIN, you could potentially offer even a higher rate of return because you can pay interest on money in a way that you can't with paper money. But more importantly, FEDCOIN is a good money because it would eliminate unnecessary exchange rate fluctuations associated with these alternative cryptocurrencies. I don't think that the government should interfere in any significant way with the emergence of these cryptocurrencies. I think my own personal view here, let these cryptocurrencies cryptocurrencies emerge and fill niche markets. Let them compete. I mean, who knows? I mean, I don't think they should be legislated away. The Fed should be offering a product that's superior. And if people want it, they'll come to the Fed product. If they want to use the private cryptocurrency, they'll go to the private cryptocurrency.